Welcome, ladies and gentlemen, to our interim results for the 6 months ended 31 August 2021. And a warm welcome to all our shareholders. I hope you find this interesting. I'm going to go straight into the slides. So, this is definitely the key slide of our company. There are details on the website that updates as the share prices change every 15 minutes, or it's delayed by 15 minutes. And you can see we had good growth from the start of the financial year up until August. The sum of the parts on a per share basis is up from 94 Rand to 110.50, and there's been a slight increase following year end. If we look at the share of assets, Consult is now by far our largest company within the group, constituting 39%, Kiro 18%, PSG Alpha also 18%, and Zeder 10%. And the bulk of the other assets is cash with 2.6 billion. Just to remind everybody, we do believe we have a fairly unique investment philosophy. It's based on 3 principles. The first is, if we look at a new investment, it needs to be a large market, because we do early stage investing. If we do get it right, we don't want to be limited by the size of the market. So if you take a company like Energy Partners with deregulation on an ever increasing trajectory, we believe we're in the right space. The retirement markets, again, are high. Education, financial services are all very big markets. Then the market has to have some form of characteristics. It's no point going up against big incumbents that are strong. So we either got to have large inefficient incumbents. So we look at where the market expects free services like energy and education. We like to compete in those spaces. And then again, where the market's extremely fragmented, PSG Consult over the years has done very well to create a home for the IFAs. And more recently, our entry into the retirement village sector. It's a highly fragmented industry. Definitely the most difficult part is the management teams. So only after you've made the investment that you actually realize how good these managers are, as you see them go through the challenges that they have to meet, and are they creative enough to build the businesses to achieve their full potential. But they have to have a differentiated operating model. It's either providing a better service, lower pricing, or give the clients a better experience. I mean, obviously, if you can do all of it, you're able to attract significant additional market share. PSG stated objective remains unchanged. We want to create shareholder wealth on a per share basis. And to state it quite bluntly, there are only a couple of ways to do this. By far, the best way to create wealth for shareholders over the long time is to grow the underlying businesses. Capitec's out of the stable, but it is definitely the best business that has been created over the last 20 years in South Africa, and the wealth that's been created through that success has been significant. Then as an investment holding company, we can obviously do interesting transactions to create additional value for shareholders. This include sell or unbundle different companies when it's opportune. And then there are also other value enhancing strategies. And ultimately, returning dividends to shareholders also creates value over the long run. So on that scoreboard, how did we perform in the last 6 months? As I already stated, the sum of the parts was up 17%. This was largely driven by the strong performance of the underlying portfolio. We did not identify any new investments that suited our investment philosophy. As we sit here today, several of our investees are engaged in various forms of corporate action, some small, some are potentially transformational. I have to caveat that though, concluding transactions remain tough with COVID. It makes due diligence more difficult, and there's a significant mismatch in many instances on price expectation. What adds more difficulty, we discuss it quite often here at PSG, is how much more difficult deal making has become from the ever-increasing red tape, as it causes significant unnecessary delays. Then we saw strong operational performance by Consult, Energy Partners, Optimi, CINS, Stadio, as well as most of the Zeder investments. And the two large companies within the group that are still affected by COVID is Kiro and Evergreen, and I'll get to them a little while later. On value enhancing initiatives, I have to reflect back to the Capitec unbundling. If shareholders retained their Capitex, and given the discount, the value unlock that we've created for shareholders is close to 17 billion, and if you put it into PSG in share price context, it's about 78 Rand per share. We repurchased the PSG Financial Services perpetual prefs in the period, so we have no debt on the current balance sheet, and we actually sit with cash. We have currently ceased further share buybacks. The effect is just not as large as we would hope. Buying back 1 billion of shares only creates increase in the sum of the parts 2%, and if we utilize all our cash, the increase is only 6%. And we believe the relatively small increase in the sum of the parts doesn't justify the loss of financial flexibility that we'd experience. And this is again goes back to the discount at which we trade. We are not able to access the equity markets at fair value. We continue to evaluate various value-enhancing initiatives throughout the group. On the dividend policy, we stated the following: with the unbundling of Capitec, you will now receive the dividends directly from the shares you received from Capitec. And the fact again that we anticipate that we'll trade at least for the short to medium term at a discount, we will only pay ad hoc dividends if we have substantial cash. So our dividend policy remains unchanged, and there is no interim dividend being paid. This is just a slide showcasing the discount to some of the parts. We were actually trading for a large part of our history close or even above some of the parts in certain instances. The split happened following the collapse of Steinhoff, and they had to place the 25% shares that they held in PSG, and ever since then the discount has widened, and now it sits sort of at the 30% level, and that is more in line with where investment holding companies for some other reason trade in the market. The liquidity has also come down significantly. Obviously there was significant trading around the unbundling of Capitec, but it's now in the 40% region. Then just feedback. I'm only going to give a short feedback on especially the listed investments. They've all recently announced their results, so for me to reiterate what the different CEOs of the underlying companies have said, I don't think is going to add a lot. All of their results presentations are on their different websites. We've included these websites at the end of the presentation. If you want more detail, please visit them specifically. So PSG Consult, we're extremely proud of their results that they did achieve. They increased recurring headline earnings per share by 23%. And we have to take into account that if we go back last year, they had an increase in earnings as well. So many financial services companies out there have significant increases in earnings, but it was due to a recovery in earnings following losses last year. So this company has consistently delivered for shareholders. Its three main divisions: wealth, insure, asset management. I'll go through a little bit in detail. We had significant inflows in wealth management with almost 11 billion of net inflows, pushing the assets under management up by 11% to close to 260 billion. We've had 60 new advisors joining the group, and they managed to push headline earnings for the division up to 234 million. The reason why it's slightly below the increase in assets under management is because broking revenue was down by about 30%. On insure, the premium income was up 4%. The advisors were unchanged. Again, Western National, of which we own 60%, had good underwriting margins, which increased to 14%. Our investment income from our float increased by 48%, and the division as a whole increased earnings by 17%. Our asset management division managed to increase its assets under management by 9% to 38 billion. They saw net inflows of 139 million. And again, for the first time in 3 years, they've earned performance fees. And these fees represent 7.8% of the group's earnings. And it was a sterling performance with headline earnings up 95%. If we get to Kiro, the business remains under pressure. We did manage to push our learner numbers for the year up by 7%, increasing revenue by 12%. But from the ancillary revenue perspective, this is all the additional revenues that you get still remain under pressure. This is now boarding fees, bus fees, aftercare, all the sport days and extracurricular activities. The revenue is still down. We're hopeful as the restrictions are lowered that schooling can return to normality in the next financial year, which should see a significant recovery in this material element of our revenue. Unfortunately, as the economic environment remains tough, bad debts and discounts remain a concern. We've doubled our efforts to reduce the effects of this going forward, and hopefully as things recover, we will be in a better position. What is worrying is the significant increases on municipal charges. We're having various engagement with relevant municipalities about the correctness of these charges. On expansion, There was a recent announcement where the Competition Commission approved the acquisition of Heronbridge. I think the school will bode well for the organisation in the future. The new flagship Durbanville High School will be opened in 2022, and the bulk of other capital investments by the group is on spending additional capacity at performing schools. So going forward, we're hopeful that the profitability will recover towards the end of the year, or hopefully be in line with the previous financial year. But it's not been all bad. We've invested significantly into our digital product offering, which in time will reduce cost and enhance operating margins. So we're excited about the prospects of this business, as long as we can return to some form of normality, because like I stated, COVID really has a negative effect on this business. Then on Zeder, they released their results last week. There was a slight increase in the sum of the parts value from 433 to 445. So for the moment, the agriculture conditions remain favourable, demand still good. However, as the fuel price increase, it will put increased pressure on farmers. And then we continue to monitor the effects on COVID, and especially the supply chains. I know that the riots in KwaZulu-Natal and the closure of the Durban port did have a significant negative effect, especially on the citrus farmers that use the Durban port to export their product. On the strategic review, the Zeder is still trading under caution. Unfortunately, we can't say anything more than that at the moment. As they've also stated, they've received a number of approaches. We are evaluating same, and we will let the market know if we ourselves have more detail on that. But as a whole, Zeder's strategy is exactly the same as ours, is to create value for shareholders. Then on PSG Alpha, over the last 6.5 years, they've managed to increase their portfolio on a per share basis by just over 11%. Just a reminder that there is no gearing to enhance return in PSG Alpha, and the employees sit under PSG Group, so there's no costs. So the increase is on a like-for-like basis. Obviously, this is below our expectation of what we would like to see from returns. It's been a couple of tough years, as we all know, but I do think that as a whole, the portfolio is well positioned for growth going forward. Here is some more details. We've used consistent valuations of the portfolio. We personally believe in uncomplicated valuation methodologies. It makes it easier for investors to understand and get a feeling for the businesses, and by keeping the information the same, you can sort of start building your own models. We don't use DCFs, and I mean, you can use them ultimately to see whether the values are fair, but nobody knows exactly how the future is going to turn out. So DCFs in our mind are flawed valuation techniques. CANS is a business listed on the Botswana Stock Exchange. It's a collection of FMCG distribution businesses. As you can see, it operates across the entire Southern African region. The biggest operations are in Botswana and South Africa, and we provide various services to principals, on which we earn a combination of service fees and commission. The business had a very good 6 months, pushing up earnings from 55 million to 95 million. A large part of that had to do with significant restrictions having been lifted. The first half of last year was characterized by hardcore lockdowns in terms of COVID. But we are hopeful that this business will continue to grow significantly going forward. There are still here and there restrictions in terms of COVID. We do move beverages for a number of clients, and ourselves and Botswana are quite inclined to close those industries if lockdown levels increase. But as a whole, business is performing extremely well. Then on Evergreen, it's an integrated developer and operator of lifestyle villages. We continue to own the property, and the units are sold on a life right basis. So we have two major sources of income. It's a fair value gain that we make on the initial sale. So we make what is akin to a property development margin. And then in the following years, when we resell it, we make a fair value gain on the uptick in value, and hopefully our properties will increase with property inflation. Just a reminder for all, the property market has been under pressure because of COVID. We've seen a slight tick up of late, but hopefully in the next year or so it will be recovered. There have been some questions from the market already in terms of occupancy at the villages. If we ignore new released units, the occupancy continuously hovers above 90%. The villages, once they are full, do make a small income on a levy basis, but we basically targeting a break-even basis. We have started with healthcare facilities and fragile care at a number of villages, and these in time, as with the levies, as the villages reach maturity, they will also start showing a small net income. But by far, if you look at this business, the bulk of the value will come from the property development margin and the normal increase in property values. Just some more detail on the balance sheet. We'll show this every time. We value this on NAV. So the NAV is backed up by third-party valuers who go to each village on a rolling 3-year basis to confirm the values. And also from our own perspective, we analyze new sales on a per square meter basis and then extrapolate it to the rest of the portfolio. This is just to show, obviously again with COVID and as lockdown levels increase, it's difficult to get new potential clients in the village. Quite happy with life at level 1, and the only construction that we have at the moment is we're building 60 new units at Val de Vie, and hopefully in years to come, if we can go to a more normal course, we'll start developing the other villages where we've land bank some sites to get our target of more than 5,000 units. Stadio, again, a listed business, so not going to spend a lot of time. They operate through 3 units. Millpark still stands on its own. It's got a big business B2B component, so we've decided to keep it separately. AFTA is totally different. It's the #1 visual arts school in the country, and they've decided to retain their brand. But all the other businesses have now been grouped in Stadio, and that is the brand that we will drive going forward. This business had a good 6 months, pushed up revenue by 17% and the number of learners by 11%, and its core headline earnings increased by 44%. Their focus of being 80% distance and only 20% contact has obviously reaped benefits with COVID, which restricts contact learning. Then Energy Partners, it's a fully integrated utility. It's absolutely in the right place, as I've stated, with the ever increasing deregulation that we see. We focused on 3 areas: solar, cooling and heating, and this is backed up by an energy intelligence solution. We would track the performance and do the billing, and numerous large corporates have outsourced large part of their utility monitoring to Energy Partners. Then on the divisions, those are the divisions. If we look at the business, it actually compromises 2 parts. It's an operating business. This is the part where we contract and sell energy installations. We do it both for ourselves and for third parties. Those would be cash sales, and as I stated, it's backed up by the energy intelligence solutions. But by far the biggest part, in which we hope to build over time, is the investment business. This is after building, where we own it and we earn recurring revenue with long-term off-take agreements. On the valuation of the business, we've kept it the same. We value the operation business at a 6x multiple, and the investment business at a 10x, given the recurring nature of the earnings. And it is very pleasing to say that where we've modeled EBITDA, the assets track it considerably well. So once you got that, you make some small adjustments, you analyze the assets that have been commissioned in the last 12 months, you add back the cash and working progress and deduct the debt, and then we get to a value. So on the next page you can see more detail on that. And again, the pleasing part of this business has been the growth in the investment book. You can see the 4.5-year compound average growth rate has been 70%, and you can see the rate of growth on an annual basis. Also of interest is the average yield on the assets. It's currently at 14.4%. The initial yields as we add assets is about 10 to 11%. So that's the reason why it's come down from about 18%. And generally speaking, solar has a slightly lower initial yield than the more complex heating and cooling assets that we're able to add to our investment book. Then on Optimi, they operate through 4 divisions: homeschooling, provide services to existing schools. We call it Optimi Classroom. We do corporate training, and we've got a college that does distance education. by far the biggest beneficiary of something like COVID has been our homeschooling divisions. Now service over 28,000 learners, and we think this market will continue to grow as it becomes a more acceptable form of education going forward. The corporate training has had some issues, again with COVID related, as people have not returned to business in full, and as such some of the training that we provide to corporates have not been there the last 2 years. But as a whole, the business is performing exceptionally well. You see the growth in revenue on this page. We value it at the average of the 3 listed investment. We've excluded, just for this round, Kiro, given its high multiple it's trading at currently. But the average of the other 2 is a 16 multiple, valuing this business close to 500 million. And we believe the growth will continue going forward. Then on the other 4 investments, I'm not going to add a lot. S&C, we stated before, has established a joint venture with US-based Taiki. This has been delayed given COVID. Carter, very impressive technology they've built. We own the number 1 and 2 Renault dealerships in the country and sell about 12% of all Renaults currently. Provest is a mining supports business, fully 51% black owned. It does remain a tough industry to operate in, but I think we're well poised to deliver if there is a recovery in the market. And Spirit is a diversified LBO specialist with 5 core investments. If you want more information, especially on the listed companies, please go and visit the specific websites as I've stated, and you can see the individual CEOs delivering the results. Before we get to the question, I'd just like to make a closing remark, and I'm going to read it. South Africa was already in a dire economic situation pre-COVID for all the reasons widely known. Unfortunately, COVID has made the situation so much worse, with more than 1 million people losing their jobs because of government-imposed lockdowns. We already spoke out against the extensive use of lockdowns given our fragile economy at our April 2020 results presentation a year and a half ago. But it appears to be a blunt tool used by governments all over the world to flatten the curve of a spike in COVID infection. We are different from many European countries that have sufficient reserves and the like. Therefore, we need to be circumspect in the use of lockdowns, and we implore the people of South Africa to get vaccinated so that we help ourselves to remain out of lockdown. For now, lockdown levels have been reduced to level 1, and that at least provide an opportunity to return to a new normal and get to the economy going. In order, however, to attract new investment and get companies to invest more in their own business, we urgently request government to provide policy certainty and regulations that are more business friendly and to reduce red tape. This will create an environment whereby business can grow. We can create jobs, and ultimately we pay more taxes that can be used by government for the good of South Africa as a whole. So our plea to government is to create a fertile environment for growth, and business will create much needed employment opportunities. Thank you very much. We'll wait a couple of seconds and then we'll go to questions.
Good morning. Yes, thank you for we've received several questions, Piet. So the first one is any views on PSG Group and the investee companies remaining listed in the future?
Obviously, one needs to go and look at the JSE as a whole. It does create a great platform to raise capital, but we are concerned about, I spoke about it, the ever-increasing red tape at government level, but it's a worrying level of red tape that we now see at the JSE. And I've actually spoken to the JSE in the past and highlighted this fact that being listed on the JSE shouldn't put you at a disadvantage of being competing against companies that have other forms of shareholders like private equity. For the moment, our businesses are listed, and we will continue to focus throughout the group to create value for shareholders.
Thank you, Piet. The next one is the cash balance declined by about 263 million. Was the bulk of the cash used to settle a tax liability?
That is correct. It was settling the tax on the sale of the last Capitec shares that we held.
Thank you. The next one is by unbundling Capitec and PSG Group management has unlocked substantial wealth for PSG Group shareholders. Thank you. PSG Group is, however, sitting with cash. Do you envisage incurring any significant debt on the balance sheet in future?
There is, looking at our balance sheet, we can hold between 1 and 2 billion of debt on a fairly easy basis. And if you add that back to the current cash, it means we've got a war chest or a potential war chest of close to 4 billion.
The next question is also relating to cash. Do you have any sort of timeline that you are following in terms of deploying that cash? If you do not pursue any investment opportunity, say in the next 2 years, will you consider paying out a special dividend?
We most certainly will consider paying out a special dividend. I think for the moment we are looking at a number of opportunities. As I've explained, we've not found anything specific, but for the moment we're going to retain it for financial flexibility, but obviously it has a shelf life. So if we don't find anything in the medium term, we will be obliged to return a big portion of that to shareholders and they can go and look for opportunities themselves.
There's 1 or 2 questions relating to share buybacks, but I think you addressed it in your presentation, so maybe I can just refer the parties to the presentation again on why you don't do any buybacks now, but I think you've elaborated on that. On Evergreen, there you've also there's also a question there, Piet. Again, you've spoken about it, but 1 or 2 new questions. Or let's say if you can answer this again, are the current trading conditions more favorable, better? And if that is so, how probable is it to recover to at least 300 units per annum given South Africa's current economic situation?
I think we've got to monitor it going forward. I mean, it's great to be in level 1 now. But I looked at the figures this morning, only 16% of South Africa is fully vaccinated. It means if there's another COVID spike, it's very likely that the government will put us back into lockdown, and that will again limit or have a negative effect on a business like Evergreen. So until such time as we reach a level of vaccination or the disease disappears and we're back to normal circumstances, we will be conservative in our future planning, because to have empty sites for too long is just negative on our return on capital.
Thank you. Has Carter made any progress with identifying acquisitions? And what is the value of the acquisition pipeline? I mean,
we continue to look at opportunities in the market. It's obviously one of these instances where it's a price expectation thing. We know that last year businesses were affected by COVID, and many players out there would like to have a normalized earnings again before they look to transact. So again, it's one of these examples where COVID essentially delays any corporate action.
thank you, Piet. Given comments around ceasing buybacks, is buybacks off the table even if new investments cannot be found in the next 3 to 5 years?
I think that's the same answer as the question about special dividend. If we can't find anything in the short to medium term, it's either returning the cash via special dividend or share buyback. I just want to reiterate that given that we trade at a 30% discount, it is important for us to retain the cash and have the necessary financial flexibility, because we cannot go to the market, to the equity markets, to get additional capital should there be significant opportunity for us. Obviously, it's not a great position to be in, but it's the reality we find ourselves in at the moment.
Thank you. There was one question specific to Zeder, but I think we'll just put them in contact with the Zeder CEO with regard to that question, as I don't think we're able to answer that. Then there's a question on CA sales. What has driven the strong earnings growth given muted revenue growth? Piet, there I think it is management being able to do very good cost management, and also the mix of products sold over this period plays a role. It's a great business, as you know, very resilient. It's a pity about the sale of liquor in South Africa and Botswana, which could have enhanced the earnings further. Then just give it another minute to see if there's further questions coming through. There's another question with regard to potentially unbundling businesses, etc., but I think you've answered that already in the beginning. There's no more questions, so Piet, over to you for a final thank you.
Thank you very much for attending the results presentation. Hopefully we will be able to give you some good news at our year-end results in April. Have a good day. Thank you.